What's up, everybody? You're tuning in to howtoPlayStock.com. My name's Casey. Today is October 4th, 2017. It's 11:16 in the morning. Um, just shooting a quick video here today, and I found an article a few days ago that I was reading on Ray Dalio. And the title of the article here, it's from Business Insider, but it says the world's largest hedge fund told clients the Fed is making a mistake. And this is in regards to the Fed unloading their balance sheet, which began on October 1st. Okay? Now, for those of you who don't know, Ray Dalio is pretty much, I would consider him one of the smartest men on planet Earth when it comes to managing money, economic policy, and how that correlates with monetary operations, etc. All right. He owns and is the co-founder of Bridgewater Associates. That is the largest hedge fund on planet Earth, basically, and it's worth about $160 billion. Okay. Um, so when this man speaks, I listen up. All right. And I'm going to just cover the article here real quick. So basically, Ray Dalio came out and he said the Federal Reserve and other central banks will cause problems by raising interest rates from historic lows. Okay, now the Fed is unwinding their balance sheet, but at the same time, they're wanting to hike rates. Okay, from the federal fund rate. Now, Bridgewater says the Fed has miscalculated the risks, such as economic sensitivity to interest rate changes. All right. The world's largest hedge fund told clients the Federal Reserve was making a mistake by raising interest rates. The Fed is basing its moves on classical cyclical indicators, um, sorry, and that's based on cycles, okay? Business cycles. That's what we're talking about here. Business cycles last usually around 8 years. We're now past 8 years in this business cycle or expansion. So we're due for a correction, and that's basically what he's touching on here, is that the Fed is basing its moves on um, cycle indicators and the desire to normalize the balance sheet. So Bridgewater Associates told clients in a private note, which was seen by Business Insider, and that's the site I'm on here, based on excuse me, based on the calculations that we do, we doubt the Fed will be able to execute its plan without causing problems. Oh, you think? I mean, think about it for a minute, guys, before I continue reading here. Uh, the Fed has, for the last 10 years, okay, pumped trillions and trillions of dollars into the markets, okay, and our national deficit has more than doubled since Obama took office, left office, and then Trump came in. All right, we're now at $20 trillion in the national deficit. So there's been a lot of money printing, Fed buying back mortgage-backed securities throughout that last decade. There's been a lot going on as far as market manipulation and the Fed intervening with free markets. Okay, so they doubt the Fed will be able to execute its plan without causing problems. Well, they're already causing problems. Bridgewater founder Ray Dalio, co-CIO Bob Prince, and staffer Melissa Safier wrote the note dated September 21st. The firm based in Westport, Connecticut manages about $160 billion, like I said. The Fed has twice raised rates this year, and investors expect it to do so a third time at its meeting in December. The central bank kept rates at historic lows following the 2008 financial crisis to boost the economy, a move originally welcomed by Wall Street on the brink, but since challenged by banks yearning for higher returns. Okay, and this is becoming a problem in the bond market. If you pay attention to the 10-year Treasury yield on the bond notes, it's for I'd say probably the past 2 years it's been kind of fluctuating in between like 2%, 2.3%, and they're worried that yield on the 10-year Treasury is going to flatline or possibly go inverse. which is not good. So, in an announcement last week, the Fed also said it would begin shrinking its $4.5 trillion balance sheet next month, the agency's biggest post-recession policy shift since it started raising rates in 2015. All right. Now, I don't know if that has anything to do with that yield return that I was talking about right there. I just wanted to give that as an example, though, because they were talking about, um, you know, Wall Street was on the brink, but since challenged by banks, yearning for higher returns. Okay, and then that's been a challenge for a lot of people, especially individuals who are in retirement years. Who are looking for a fixed income investment, such as Treasury bonds. Everybody's looking for higher returns, and they're just not there. So that was just an example I wanted to give you on the 10-year Treasury note. But moving forward here, in the note under the header, why we think going down this path is a mistake, Bridgewater laid out 5 reasons. Okay, and here they are. Number 1, there's not nearly enough inflation and overheating risk to make concerns about inflation and overheating of paramount importance. The Fed's target for inflation, they've always been trying to get to about 4%. Okay, right now we're roughly at about 2%. So they would like to get to 4%, but they can't. And there's not nearly enough inflation right now, from what Ray Dalio is saying, to do what they're doing. They need more inflation so that they can make money back. Okay, and all inflation is a rise in prices. Okay, a rise in interest rates. That go along with the rising prices are going to help people make money back. And I guess that's essentially what the Fed's trying to do here. But he's just saying that there's not enough inflation in order to do that just yet. Number 2, risks are asymmetric on the downside. It's tougher to reverse an economic and market decline with an easing, that is, to reverse an economic or market acceleration with a tightening because of the proximity of interest rates to 0%. And because easing with quantitative easing is now less effective. All right. Number 3, tightening at rates that are faster than are built into the yield curve is likely to trigger negative wealth effects because the effective durations of assets are now very long. All right. And this kind of goes into that yield curve on the 10-year Treasury note that I was just talking about. Okay. Now I was saying they're afraid it might go flat or inverse. This is what he's referring to here. Now, the other part that I think is very interesting is that the Fed, okay, before 2008, they were able to borrow money from the long term to pay for short-term debt. Okay, so they could borrow in the future to pay off short-term debt. Now things are so bad and upside down that the Fed has to borrow from the long term, or I'm sorry, they have to borrow from the short term now to pay off the long term debt. Okay, so it's basically backwards. They're borrowing from the short term to pay off the long term debts, and before they were able to borrow from the long term to pay off the short term debts. If that makes sense, okay? So it's just reversed. And that's not good either. Number 4, economic sensitivities to interest rate changes are greater than normal because the level of global indebtedness and non-debt obligations, especially pensions and healthcare, in dollars and other currencies is high. Okay? Number 5, a downturn in the economy would be intolerable to those with lower incomes and wealth and would make social and political tensions dangerous. Well, I would have to say we're approaching the political tensions being dangerous right now. I mean, if you look at what's going on the political scale, geopolitical tensions between China and North Korea and all that, I'd say they're already pretty high. And a downturn in the economy, that's not going to be good for people with lower incomes, of course. I mean, that's what he's stating here is, I would say, the obvious. And it's one of those things where I think the Fed is so focused on trying to keep the markets propped up because they don't want the economy to come down, or the stock market to come down. Okay, now a downturn in the economy, when you look at cash flow or the movement of cash, oh, what's the word they use here? I'm trying to think of it real quick off the top of my head. It's money velocity. Okay, money velocity. When you look at money velocity, which is the cash, the amount of cash flowing and being transacted on a daily basis in the economy, I would say we're already in a downturn. They don't want you to know that though, because uh, it's basically people are going to wake up and realize that we never had a recovery. Okay, especially with all the quantitative easing that we've done. So I've talked about this in previous videos. I talk about the market melt up. If you're not familiar with what that is, you can go back and subscribe to my channel, and you can look for that video where I talk about the market melt up. But essentially what they're going to do, or what they could do, and the Fed has the power to do this, is just print money into oblivion and continue intervening in the stock market, buying company shares and propping the markets up to 50,000 points on the Dow. And if you look at the Dow right now, I don't know where we are today, but it's been in the 23,000. Well, let's just go check it out real quick and see where we are on the Dow Jones. Dow Jones today. So yeah, I mean, we're at 22,679 points. If you look at the charts, since 2013, it's just been up. It hasn't gone down much at all. And it's just, look at that chart, guys. That is not a free market. That's not what free markets do. If you want to know what a free market does, just go over here. We can look at Litecoin, okay? The price movement in Litecoin, for instance. And this is kind of a bad comparison because I'm looking at one asset in digital currency versus overall broad markets. So it's not a very good comparison, but it's a good example of what a free market looks like. This is a free market. It goes up and down like this. What you have over here on the Dow Jones is just parabolic up. And what I'm saying is the Fed can continue printing money, and this figure here, 22,679 points, could go to 50,000. And, excuse me. And, if you got a 401k and you're looking at that and that's all you're paying attention to, of course you're going to think you're wealthy. But what you have to realize is that your purchasing power, the amount of money in your back pocket, if the purchasing power of that goes down and it costs more dollars to buy stuff, well, you're not really wealthy. So it's part of the illusion, and that's a big part of what I think people miss when it comes to looking at the currency, the U.S. dollar, and where we are. Okay. I'll go ahead and wrap this up here. Dalio has previously discussed this topic, most recently while making the rounds at media outlets to promote this new book. And of course, I'm sure there's some financial interest involved there on his end to promote his new book. But when this guy speaks, I listen up. In an interview with Business Insider's Henry Blodgett this month, he said the risks are asymmetric on the downside if you tighten monetary policy, certainly by more than is discounted in the market, and what's discounted in the market is a very minor rising market that will reverberate through asset class prices. So what he's saying is, get ready, because the asymmetric risk reward is on the downside. And I've been talking about this for a good year and a half. Right now, if you're looking at investing in the stock market and you want to get in and put some skin in the game, you got to ask yourself, what are the odds you're going to lose money? Because if your odds are really high that you're going to lose money, why would you invest in the stock market? I mean, other than maybe having a 401k set up so you can take advantage of matching from your company, which is just free money. Other than that, why would you get involved? And that's something you have to ask yourself as an investor. What are my odds? I don't like those odds. Okay, and I've known this for a while. I've read some of Ray Dalio's material, and that's what I started paying attention to a good year and a half ago, was asymmetric risk reward, and he's saying it right here. Now this article is just written 6 days ago, so it'll be interesting to see what happens, guys. But if you're in it for the long term, one thing I like to tell people, and this is just my opinion, I'm not a financial advisor, but if you're going to invest for the long term, why would you get in at the top? Because you have to look at your age, you have to look at the amount of time that you have left. Okay, for somebody like myself, I'm 36. I've probably got a good 30 years left, hopefully. And yeah, I can afford to take a 70% decline or a 50% hit on my long-term investing. But outside the 401k, I just don't see I don't see the point, because I have to make all that money back. And if you're somebody who's got time on your hands, you can most certainly do that. Just stay in and take the hit. It's going to take longer for you to get your wealth back, though. And if you don't have to participate, why would you? If you look at PE ratios right now in the overall markets, they're like 4 times overvalued. Okay, and I'm talking about the broad markets. So the PE ratios are way out of whack. You're talking about 4 times overvalued. Ask yourself, if you went to go buy a house, would you buy a house that's 4 times overvalued than what it should be worth? And you have to look at the stocks the same way. And my answer to that is hell no. I'm just gonna wait. I'll just wait. And here's the cool thing. You can change excuse me. You can change your strategy from more of a long term to a short term if you want, and invest in assets that are way undervalued, or start dabbling around in markets that are more open and free, such as digital currencies. Okay, I'm not saying that's the end all and the only choice you have as far as getting into markets that are free markets, with very little intervention from central banks, but at least there you have a fighting chance. With the stock market right now, you really don't have a chance at coming out alive on the other end of this if you're in it for the long term, and you're hoping that the stock market just keeps going up and up and up. Because yes, it's going to go up for a little bit longer, but eventually it's going to come to an end. And I would rather be on the opposite end of that trade, make a lot of money from being in undervalued assets that are going to go up when the overall broad markets go down, and then sell when I'm getting closer to the top, make my profits, and then come back into the markets and buy when they start reaching fair value. Okay, but those are my thoughts on this article and what Ray Dalio had to say. Let me know what your opinion is on this and what your thoughts are. If you like the video, go ahead and hit the like button. You can subscribe to the channel as well. And remember, guys, income is the outcome, okay? I'll talk to you later.